So today we want to start with this Burton Makiel video and respond to some of the points that he makes, and then I want to go to a second approach to mitigating price risk. Last class, well, really a third approach. Last class we talked about assuming correlations are stable and standard deviations are stable, and using an efficient frontier approach to mitigating risk, which is what Burton Makiel is talking about. We then talked about maybe a better approach is not assume correlations are stable over time, and they're unstable because asset classes react in different ways in different environments. And so what we need to diversify is not asset classes via correlation, but asset classes via environments. So we make sure we're protected from different types of environments. Like we have gold at a time when inflation's a problem, or at a time when there's a lot of risk, or you have treasury bonds when there's a lot of risk. So let's talk about what Burton Makiel says. He's the author of Random Walk Down Wall Street, so obviously a very well-known person, but he makes 3 points that we want to address. The first, he says, is diversification has come back. Stocks and bonds are now negatively correlated. And he showed you a chart. He showed that the last few years. He's doing this as of 2010. He says the last few years we've seen stocks and bonds go negatively correlated. The second point he makes, well, the second point I want to bring up, he doesn't really make it, but he keeps using the word bonds, and so I want to understand that concept of bonds and what he means by it, because it may not mean what he thinks it means or what we might think it is. Then he said emerging markets are highly correlated, but still was good to have them because they had a positive return when everything else, well, let's say not everything, but all other stocks were negative. So he says, okay, it might not have reduced your standard deviation much. They might have moved very much in line with, especially other international stocks. But emerging market stocks over that time, while they had the same pattern, the same in volatility, high correlations, at the end of it all, they were up 10% when everything else was down. And so that's his other point that he makes. And then his last point is gold is a good diversifier. So let's look at these points and see what we can do to address them. So let's start with this first one. We talked about this one already, and we said, of course they are, because inflation is not a focus of markets right now. So we said that when we were talking about the different environments, and we said in environments where the markets are not focused on inflation, stocks and bonds are negatively correlated. And that's exactly the period of time Burton Makiel was talking about. He's talking about financial crisis, the dot-com crisis, the financial crisis of 2008. No one was talking about inflation there. They were talking about risk and recessions and global events. And because of that, bonds did extremely well and stocks did very, very poorly, negatively correlated. So he's exactly right. Bonds and stocks are negatively correlated as long as, so this will be true as long as inflation is never an issue for markets again. Even here recently, we're starting to see more and more discussion, more articles, more reaction by the Fed chairman and others with this concern about inflation. There's been several concern about what Congress is doing with the latest stimulus, that it may just be too much. And if people actually do start spending it, if velocity of money actually goes up and people start spending this, we could have a case where inflation does take off and becomes a concern. Right now, it's not. So right now, yes, stocks and bonds probably are a good diversifier. But that's the first point that he makes. So let's put those in there. Now let's go to this next one. He says bonds. What does he mean by bonds? And I'm going to just tell you, when he says bonds, he means Treasury securities. To get the kind of diversification and benefit he's talking about, you have to have Treasury securities. But that's not what people buy. Most investors avoid Treasuries and buy corporate bonds. Why? Well, I remember at UTSA, when I had my first job as a security analyst, I bought a Treasury. I put $5,000, just $5,000 into a Treasury. The only reason I did it was my curiosity about how the system works. I went to treasurydirect.gov or .org or .com, I don't remember what the website is, and I put my name into for $5,000. I went into the auction. I was just going to get the average of the auction. I just want to see, I'd read about that process. I'd seen it in textbooks. I just want to go in. And so really I wasn't even buying a Treasury because I thought it was a great investment. I was buying a Treasury to learn the process. But the portfolio manager, he found out I bought a Treasury. He came over and he chewed me out. And he says, we don't buy Treasuries. And the reason he said that is if you look over time, corporate bonds, the extra return you get on corporate bonds, more than covers for the extra risk. And we'll talk about that later. We'll talk about this later when we talk about credit risk and how much corporate bonds are really priced to give really good excess returns over their risk. The problem is corporate bonds are not negatively correlated to stocks. So what he was talking about, all the things he's talking about, those charts of negative correlation, the great diversification, doesn't apply to the corporate bonds. Corporate bonds were actually negative in 2008. Some of them were down 10, 15, 20%. I know there was a portfolio, it was an investment grade portfolio that I was heavily involved with. And the portfolio manager, he was down 15% in 2008. It was just a tremendous, difficult year for him, his worst year ever in his profession. So you've got to consider that he's using the bond, and I really think this is one of the biggest dishonesties in this profession, especially in financial planners. They like to use Treasuries when they're trying to show diversification, but then they put their clients in corporate bonds that tend to do very poorly. When stocks do poorly, spreads tend to gap out on corporate bonds. When the stock market is crashing, these bonds can have definite negative returns during a financial crisis. And they'll definitely underperform, especially triple B bonds and high yield bonds will definitely underperform Treasuries by a significant amount in a recession or in a financial crisis. So I agree, I actually think long Treasuries can be a really good diversifier for a portfolio. Long Treasuries will do really, really well in a financial crisis. They will not do really well in an inflationary environment. And so if we go back into inflationary environment, the numbers he's showing are just not going to be there. Your portfolio is going to do poorly. That's why the 1970s were such a horrible time for investors. Stocks and bonds both did badly because inflation was taking off. Now let's talk about this next thing. He said emerging markets, yeah, they're highly correlated. He kind of threw in the towel on that one. So emerging markets are highly correlated. So as far as their impact on reducing your standard deviation, it wasn't all that great. But how could you have avoided them? They had these wonderful returns. They were up 10% when everything else was down. And the problem with this is this was true for that period of time. The last video I said everything he's saying is very, very time dependent. So it was true for that particular point in time. The 10 years since what has happened. And so it's kind of interesting. So he had a high allocation. He was recommending 17% in emerging market stocks. That's a high allocation. And then he wanted another 17% in developed market stocks. That was his recommendation. So you need to do that instead of buying U.S. stocks. And he said for the 10 years he just looked, they did better. And that was true. If you had done that for that one period of time, you would have noticed that his portfolio, that $1, let's start with $1, $1 in his portfolio would have grown to $1.18 with only U.S. stocks. It would have grown to 0.72. So he's exactly right. In that particular point in time, emerging market stocks were a great benefit. Since then, his portfolio would have made $2.81, $1. If you'd reinvested $1 in his portfolio, it would have made $2.81 versus $4.51 for U.S. stocks. For the entire period, it was a draw. The returns were the same. Returns same. Risk was slightly lower for his portfolio for the entire period, but not much. He essentially ended up with the exact same return over that 20 years. However, at the time he was talking, at that time, 10 years, he's saying, hey, this is what you should do, 17% emerging, 17% in developed. If he'd gone with that allocation at that point in time, you would have been much worse off. So it's extremely time contingent. Does that mean he's wrong? No, I actually think it makes sense to invest in emerging market stocks. Developed market stocks have just been terrible for investors for the longest time. But I even think, it makes some sense to invest. Makes some sense to invest there. Those markets actually look quite cheap today versus the U.S. market. So going forward, that might be the right place to be. But to just say that he's proven that the allocation emerging market stocks makes sense, his proof only works in that one particular 10-year environment. It may or may not work in any other 10-year environment, and in fact, it can be 17% in emerging markets, and especially 17% in developed market stocks can do tremendous damage to a portfolio in a time period like the last 10 years. So I'm not saying I disagree with the allocation, although I do think 17% in emerging market stocks is an awfully high allocation for an overall portfolio. I don't think it's a high allocation if you're just looking at the stock piece. 10 to 15 to 20% in emerging markets as a percentage of your stock portfolio, I think makes sense. But 17% of the overall portfolio seems a little bit extreme. But why did he recommend that? Because he was looking at historical numbers, and his investment frontier said, hey, based on the expected return and the risk of emerging markets, we should put 17% in emerging markets. I'm a fan of them. I do think they make sense. I do think an allocation there makes sense, but it's not always a sure bet that it's going to work for you. Let's take his last argument. Gold is the diversifier. I'm going to say I agree. That's what we've been saying. Gold is that unique asset class that does well during inflationary periods and does well during crisis. It's the only one that does well in both those two periods. While bonds do really well in a crisis, they do terribly in an inflationary period. While commodities other than gold, things like steel and silver, while they do well with inflationary environments, they don't do well in a crisis. So gold is a unique risk. So what's the challenge here? How much will you put in your portfolio? When I was working with the guy who ran the gold fund at USA, and our discussion was 5–10% is probably the most you would ever put. And he wasn't talking about gold, he was talking about gold stocks, companies that produce gold, which is a very different thing. These are actual businesses that have cash flows, they're mining, they're finding stuff. So these are actual businesses that you can value. Gold is not a business, it doesn't have a cash flow, it's a very speculative asset. We really don't know what the expected return on gold is, other than we know it will probably keep up with inflation or even beat inflation. We know it's going to do well in a crisis. But gold prices are up. They've been up quite dramatically here in the last few years. And they do well in a crisis. So they would be a diversifier. So you've got gold and long treasuries that do well in a crisis. And then you have gold that does well in inflation and long treasuries that don't. So yeah, gold does play a part in your portfolio. You probably should have some, but you're probably not going to have a high enough allocation that's going to have a dramatic impact. Now, the presentation I showed you last class, the HWC, what I forget what it was, but that gentleman, the presentation he made, his presentation was recommending a rather significant allocation to gold, 25% to gold. That is an allocation that would have just been disastrous in certain periods of time, and you would have just have done a much worse than in other times. So there are no perfect solutions here. I think with the argument that I got from the last presenter before Burton, Makiel, him saying, you know, there's the inflationary environments, there's the growth environments, and that corporate spreads and that gold prices can predict which environment you go into. He's actually recommending you look at his predicted value, and then you actually move your portfolio to really over allocate whatever asset class you need. So if you're going into an inflationary period where growth will be okay, then go into commodities. If you're going into an inflationary period where it's going to be slow growth, a lot of risk, then go into gold, over allocate the gold. If it's going to be a low inflationary period with a lot of growth, then go into stocks. If it's a low inflationary period but with weak economic growth, then go into bonds. Yeah, and he's saying you can use gold prices and bond spreads to predict that period. I haven't tested his model since I heard from him. It seemed a little too good to be true, his actual numbers, so that there's a very high predicted value of what he was doing. So it would be interesting to see what's happened since then. But you can see what I'm arguing is the big guys in finance, the big names, they disagree with me. They still push diversification. But I think there's some tricks to what they're saying that lead you down a path of incredible loss in certain environments. His first argument is going to lose you a lot of money if the 1970s happened again. The second one's going to lose you a lot of money if the 2008 happens again, where you have a liquidity crisis and corporate bonds blow up. This one's going to blow up on you if we have an environment where, you know, emerging countries, international stocks are just not doing well, and that's been true a lot of period of time. This one works, it makes sense, I agree with them, but I think it's limited because you're probably not going to do more than 10% in gold. And even then, you're going to feel the pain when gold prices fall. That's going to have a huge impact on your portfolio. So where can we go from here? What can we do with this information? So you have the traditional approach that you'll do in your risk management project. You have the environment approach, which gives you some ideas but doesn't give you a precise thing to do. You'd have to go read more from what these two firms I gave you are writing and see what that means to execute. Or is there another approach? So let me show you one other approach I think you should at least consider, and that's the approach of use of options. So I want to show you an option strategy. I didn't update it for 2020 just because I just got a little lazy there, but in 2020 would have been interesting given the path that the market took. So it would have been interesting. We probably would have done some transactions in 2020 with this strategy that would have changed the outcome. But this is a very simple strategy. I just want to show, I'm not recommending this strategy. I simply want to show it to you so you can see my point that I think there are ways to use options that can greatly enhance returns of certain types, returns and risk of certain types of portfolios. So what we're going to do here is talk about what's called a protective put portfolio. What a protective put portfolio is, you own stocks. Here we're just going to do U.S. stocks, 100%, and you hedge it. You hedge that risk with put options. So how do put options work? So if you haven't seen put options, a put option is a contract that you enter into which says you have the right to sell something at a given price. And it's key that it gives you the right to sell something. A call option gives you the right to buy something. So we're talking about buying a put option. So the put option gives you the right to sell something at a price. So that's kind of nice to have, because what that means, if the thing you're hedging falls in price, let's say you're hedging something and it falls from $500 to $400, but you have a put option that gives you the right to sell that for $450. So when it falls from $500 to $460, you'll lose 40 bucks. When it falls again from $460 to $400, the most you can lose is $50, because once it hits $450, you have the right to sell it for $450. So if it falls all the way down to zero, you still have the right to sell it for $450. And so your max loss is $450. That $450 is called the strike price, the price you can sell it at. So the most you can lose is the portfolio minus the strike plus the option premium. So let me use actual numbers here so you can see, just real simple. So let's say your portfolio is 1,000 and your strike, let's say, is 900, and your premium, let's say, is 20. Your max loss, the max you can lose with this. So if this strike is hedging this portfolio, so maybe this is the S&P 500 and you're using S&P 500 option, the most you can lose is your portfolio value minus the strike plus the premium, or $120, the most you can lose. So if this portfolio falls to $200, the most you'll lose is $120. You won't lose $800. And so that's what a protected put is. It is expensive. It does cost you money. So what I did here, and I haven't updated this in a while, and part of my problem with updating some of these files I've been showing you is that I've been locked out of the FSC because of some issues with just what's going on with COVID, and I'm trying to get back in. They assure me I can get back in, but so I wasn't able to update these numbers through 2020 with new numbers, but these numbers work really well. So I just want to show you a strategy. This is not always going to be the answer. It's going to be vary over time depending on how options are priced. So this is an actual option strategy. So what I want to do, and this is really, really important, let's talk about, let's say this is a 70-year-old person, and their financial planner recommended 40% in stocks and 60% in bonds. Very, very conservative portfolio. And so there you have it. There's their portfolio. And so what we're going to ask is, okay, so it's very conservative, only 40% in stocks. Is there a better solution out there? And so what I'm recommending is, this is the recommendation. Some people get confused on my pension borrowing to invest, and borrowing to buy stocks, and my pension ALM solution. This is not part of my pension ALM solution at all. My recommendation is don't do 40% in stocks, do 100% in stocks, and then hedge the stocks. All right. Now, how do you hedge the stocks? Here, I'm going to show you a real simple way. I'm going to do that protective put approach. So let's look at these numbers when we do this. So our stock returns back, I forget how far back I went, 94 or something, yeah, 1994. Our stock returns for the last 30 years would have been an average return of 11.37%. Your best year would have been 37.44. Your worst year would have been 37.20 negative loss. On the bonds, you would have averaged 5%. One year you were up 18%. One year you were down 2.92%. That was your worst case. But your 40-60 portfolio had a return of 7.74%, which is essentially just 40% of your stocks and 60% of your bonds. I mean, it's essentially that's 7.74%. Your best year was 2606. That may not be, that's not going to be 40 and 60% of that, unless those just happen to be the same year. And your worst year is 1166. And again, it might not be, you don't expect these two to have their worst year at the same time. So there you have a 7.74% return. That's not bad. Well, let's look at the option side. On the option side, your average return is 933. Though that's not as good as stocks, but it's much better than your portfolio. Your max loss, your max gain was 33.82, much better than your max here. Your max loss was 1362, a little bit worse than here. However, the thing that we can definitely see here is the protection you get. Let's say stocks were to fall 80%. If stocks were to fall 80%, you would have lost a third of your money with this strategy. But with my strategy, with it hedged, the most you can lose is 13.62%. What if you lost 99.99999%? You'd have a huge loss here, but your max loss there is 1362. That's your portfolio minus the strike price plus the option premium. Your max loss is 1362. And that's just if the stocks fall. It's possible we get a disaster like 2008. And so you look at a 2008, bonds were up, but that's because I'm using a very generic bond strategy here that includes treasuries. If you had a typical corporate strategy, they could both be down at the same time. So it is possible there's a worst case scenario that could be worse than what we've seen here. But what we know here, and that's why I like this strategy, is you have a higher expected return than if you put 40% in stocks and 60% in bonds. So let me put these advantages. Number one, higher, and make sure you know I'm talking about this versus the 40% stocks, 60% bonds. I'm not trying to find something that's going to beat the stock market. I'm trying to find something that beats a very conservative portfolio. So higher expected return. You have a max drawdown. So in this case, 13.62% is the most you can lose. And that's going to change over time, but when you set up a portfolio, I do this out really 2 years. So if you set up a portfolio, you know for the next 2 years, the most you can lose is 13.62. I set it for 2 years, but I roll it forward every year. So I can tell my client, for the next 12 months, the most you can lose is 13.62%. Doesn't matter what the stock market does, doesn't matter what the bond market does. Your max drawdown is 13.62%. Well, that's kind of nice to know. What else do I like about it? Well, right now, bond yields are historically low, so expected return on bonds is very low. Now that may be true of stocks as well, which would impact this strategy as well. But the question is this the best time to put 60% in bonds? So that's the other advantage. In this strategy, you could do more than just U.S. stocks. Here I'm doing U.S. stocks. You could do this strategy with U.S. stocks, emerging market stocks, developed market stocks. You could actually kind of diversify it across the world and have it all protected. And so then if the U.S. bond market and stock market are both overvalued, then you at least have, maybe the cheap emerging market stocks or developed market stocks, you have something to give you some protection. And the other nice thing in here is this for a year or more. The way you set it up, this second one, I should have put these in a different order, so let me switch the order here. So you have a higher expected return with my 100% stocks that are hedged versus a 40% stocks, 60% bonds. Your max drawdown is greater than the max drawdown for the 40%, 60%, but the historical max drawdown is more, but the guaranteed max drawdown is 13.62%. There is no guaranteed max drawdown on the 40-60 portfolio. I can't do that. If you put your money in stocks and bonds, they could be down 40, 50, 60%. And we know this max drawdown for a year or more, depending on how we set this strategy up. Now, next time we have to roll it forward, that might change because option premiums are going to change. And so that's the one challenge with this, is you have to constantly be monitoring it and adjusting it based on what option premiums are. But you do know, once you set it up, and you can go out on options a year or two, once you set it up, you know for sure what's going to happen. And then the other question is, do you really want to put people 60% in bonds right now, given how low yields are? So I like the strategy. I don't actually like this strategy as my recommendation, but I like the concept of using options to try to create a better portfolio in terms of risk return. Now, we could do the standard deviation of these portfolios, and let's look at that. We're going to talk about this maybe later in class. I think we actually talked some about it earlier when we were talking about when we were doing the value at risk problems. Remember I said we had one scenario where the hedge fund manager says, hey, standard deviation parametric value at risk overstates my risk because I have an option strategy and that overstates my risk. So I think we're going to see that here, but let's try it. Let's do the standard deviation of this portfolio. 17.8%, that's about what you'd expect. Stocks are somewhere between 15 and 20%. Bonds, very low, right? 4 to 5%, we talked about that. And your portfolio has a 7.79 standard deviation. And this portfolio, I just showed you, has a twice as high of a standard deviation. So it looks a lot riskier. So you have to say, wow, should I put my customer into something that has almost twice as much risk as their portfolio? But it's really not that risky. And why is that? Why is the 14.6 not the right measure of risk? Because we have a skewed distribution. We've cut the downside risk off. We've taken the distribution and we've gone to the downside and we just cut the tail off. I like that term. We cut the tail off. The left tail. Sounds kind of brutal and violent, but we're talking about a normal distribution tail, not the tail of an animal or something. So we cut the left tail off, but standard deviation doesn't know that. Standard deviation assumes it's normally distributed, and that standard deviation is going to capture that risk, but it doesn't. It overstates the risk. Most of that standard deviation is coming from the upside, not coming from the downside, because the downside is protected. Now, the big flaw with this strategy, and I'll just show it to you right now, is how it's just kind of a black swan type of scenario. You've got to if you got to consider what taking 1 or 2 years out would do. So if we take out 2008, you take out 2008, the downside risk of our 40-60 drops dramatically, whereas the downside on our strategy doesn't drop that dramatically. And so the big key for this strategy, the reason it looks so good, is because 2008 happened. Because 2008 happened, where you had that 11% drop in the portfolio, that is it. Other than that 1 year, you did not get such a crazy downside. So this is very skewed to that 1 year. And actually 2008's when this particular option strategy had its worst year as well. There's another one in there, but it's really, I guess there's two of them in there, but you can see there's a couple of negative 14s in there, but you can see that your average return is 9%, much better than the 40-60, but you protect on those downsides. So that's the one negative. You need some 2008s for it to work. So if you did this strategy for it to work well, to protect, now let me make this clear, protect the downside. If you get into a 1990s type of market, this strategy will actually probably do pretty well on a return basis. It'll probably still give you a much higher return in this portfolio. It just won't give you the downside protection. So I'm talking only the downside protection. To get that downside protection so that you see a large loss on the 40-60, you have to have a 2008. Without a 2008, the 40-60 strategy just will not look that bad. So if you're not expecting any more 2008s, then this strategy is perfectly fine for people in their 70s. If you tell them, hey, we'll take care of the 2008 risk. We'll just assume we never have another 2008 again. And they only have 20, 30 years to live, but they're 70 years old, so there's a good chance you won't see another 2008. In that case, this strategy is perfectly fine. However, if you have someone who has significant wealth and they just can't take a large drawdown and they want to have some protection, and who knows what the next crisis is going to be. Your worst case was 1166, but who knows? They may have a 20, 25. If you want someone that you can tell them, hey, I can get you more return, but I can guarantee you the max you will ever lose, I think that's appealing, especially to people with substantial wealth. All right, but that's not necessarily the best strategy. I do think there's better strategies out there. I've been looking for them. I still haven't found the one I think is perfect. I've been testing several. But let me show you a couple other approaches. So this is a spreadsheet. It's a little old. The S&P was a lot lower when I last updated this spreadsheet. But let's look at it, and let's assume that we have this set up. You have a portfolio value of $350,000. So again, this is a very similar type of thing where if you compare this to the stock market, you'll be better off just buying stocks because it's really going to limit your return. So I want you to think about this in terms of a substitution for a 40% stock, 60% bond. So I'm looking for a substitute for a very risk-adverse investor. And let's say they have about $350,000. And we're going to use calls and puts. So why are we doing that? Well, the problem, remember, with the put strategy is it's expensive. You got to pay money for the put. So what we're going to do is we're going to try to cover some of the cost of that put by selling call options. So what does that do? Well, call options, if you buy call options and the price goes up, you make money. But if you sell call options and the price goes up, you lose money. So we're actually going to sell call options in this strategy and buy put options. So it's the protected put strategy that we have, but we're going to sell some call options. So essentially what we're going to do to think about it, the distribution with the tails, we're still going to cut off the left tail, and then we're going to slice some of the right tail to help pay for cutting off the left tail. And we're hoping we can do that without radically changing the expected return too much. And so I'm going to go out about 6 months. You can go out further. I could have set this up in so many different ways. I'm using real life numbers here. I just haven't updated them in a while. So you set up your portfolio. It's going to get this executed. It's going to cost you $350,000. So what happens in different scenarios? So let's try this first scenario. What if the S&P rises 30%? Your portfolio will be up 18.05. So let's try that. Let's just keep a kind of average. Let's say bonds, and I don't know what they're going to do, but let's say bonds make 5%. So a 40-60 would make what? So you have that times 40% plus that times 60%, and I actually don't think bonds were going to make 5%. I think you're going to be lucky to make 4. So if you do 100% in stocks with this hedge strategy, if stocks go up 30%, your portfolio will make 1805. If they're going with that traditional 40%, 60%, you would have been up 14.4. So you would have done well there. What if the S&P had fallen 30%? Well, in this case, you would have been down 11%, but you would have lost about the same amount with your 40-60. What if the S&P had done like in 2008 and peak to trough had fallen 50%? Well, again, the max you can lose here is about 11%, but you can see that your 40-60 portfolio can be down 17.6%. And then what if the stock market were to fall 90%? In that case, the world's over, it's ended. And so yeah, there you actually even do better. So I have it skewed a little bit, so you get a little benefit as the markets keep falling because of the way it's set up. What's the downside on this then? Your expected return is much higher, and your downside risk is lower, except for there's a few places where you kind of tie. Where the problem with this portfolio is at the 0 point. At the 0 point, where the stocks make nothing, you're down 3.48%, and the 40-60 is up 2.4%. So you're going to be worse than everything. You will do worse in the stock market. You'll do worse in the 40-60 because you would have lost 3.5%. And that's just the cost of setting up this particular strategy. So anytime you get really small returns, like 1%, 2%, 3%, you can't do better. So you might ask, where's the break even? So stocks up 10%, 20%. There comes a point where it kind of breaks even. I think this is the thing I don't like most about it, is stocks only make 10. It doesn't do all that well. But on average, you will do better than the 40-60. And the reason for that is the stock market doesn't go up 8 to 9%. It goes up 20%, then it falls 30%. It goes, it's rare. I can even show you on the previous page. You just look at the historical stock market. So there's one, you would have been hurt, but then you would have done great in all of these. You would have done okay in that one. You would have done well there. You would have done well there. Great here. There you wouldn't have done very well. There you wouldn't have done well. You would have done okay there, not well there, great there, okay there, bad there. That would have been a bad year for you. Good, okay there, great there, okay there, bad there. Most years, because the stock market tends to either have huge returns or low return or negative returns, that average 11, it's rare for it to actually get 11%. 2016 was an unusual year. So from that standpoint, the 15%, you're doing okay. 16%, you're kind of tying. Get up to 20, you're ahead. So a lot of those markets you work, if you go down 10%, yeah, there it looks pretty bad. You lose 10, but that's the most you can lose. So, I think for a lot of people this makes sense. Now, I'm not sure this is the best strategy either. I've been thinking about different strategies and trying them out. So my goal in looking for a strategy, my goal is I want to be able to guarantee a max drawdown. So this is a very different way of investing. If I were 20 years old, I wouldn't care about that. I'm starting out, I got 50 years to invest for retirement. If the market falls 50%, I'll just buy more stocks. I'll be aggressive and invest more. If If the market falls 10%, who cares? You know, it's noise. You don't have much money invested at that point. So I'm really focused on someone who's in their 70s that they need some guarantee the max they can lose. I want to have a higher expected return than a conservative portfolio, and this is pretty important as well. I'm not trying to beat the S&P 500. You cannot do that with an option strategy. There is no option strategy out there that's going to give you higher return than the S&P 500 and cut off the tail of the distribution. But I do think there are strategies out there that give you higher expected returns than conservative portfolios where you can cut off the tail. So those are my two goals. I need, and this is the part I haven't gotten yet, is I want to somehow prepare the investor for those 0% market returns where this strategy, this hedge strategy, is the lowest. That's what I'll worry about. When the market is 0, bonds are up 4, so your portfolio would have been 2.4%, and instead you're down 3.5%. How do I prepare my client for that? And can I eliminate that? Well, to eliminate certain things, you've got to do it either at the expense of pushing your max drawdown further or reducing your expected return. And so everything's a moving. So if you don't want your max drawdown to be so low, you're going to have to reduce your expected return, and you're going to have a much more serious 0%. If you want to increase your expected return, you're going to have to reduce your max drawdown. So anything you do between these is one's going to hurt the other. They're in competition with each other. So my goal is to find some Goldilocks kind of perfect mix of these that will meet for a client. And it may depend on the client. There's certain clients. I met with one person in San Antonio. He was a high net worth individual, tens of millions of dollars. He loved this strategy. He thought it made sense, but it took a while for us to get it set up. And his son's really sharp in this area, and probably come up with a better strategy. I should probably go have lunch with his son after he finishes graduate school, because he's gotten a lot of experience. Options might not be the answer either. There might be another approach, but you see what I'm looking for is, don't stick with just tradition. Let yourself go unconventional. Think of ways that you can meet your clients' needs. Traditional approach is, we'll hope history repeats itself, that historical data tells us what the risks are. We'll never see another 2008 again, so we'll protect you from that by just assuming that never happens. Is there a better approach? I'd love to start a firm that just does these type of strategies. There's a few of them, especially with longevity products. I'd love to combine with these strategies. I think there's a better answer out there, but you would need a lot of IT people, some actuaries, decision scientists, investment people. Sit down and really brainstorm what is the best answer. And I don't think the industry is doing it. And that's kind of my other thing. The industry is not looking for this better solution. And why is that? We've already answered why. Career risk. Career risk and how we are compensated. The industry pays a lot for the conventional approach, and it beats people up for being unconventional. So you're getting paid a fortune for being conventional. You get beat up if you're unconventional, if you're wrong just once. Industry says, why should we even bother? Stick with what we're doing. It works. It's safe. We don't have to worry about lawsuits because we're doing what everybody else is doing. We don't have to convince the client of this. If we do this approach and the first year just happens to be the 0% year, and all our clients leave us and we're done for, that's what the industry thinks. The industry is here because of career risk, and that's what they focus on. So when you have a focus, when the focus is on the finance professional and not on the client, solutions do not arise. There is no innovation, and that's kind of what we've set up in finance. So I'm trying to get some of y'all excited that after 5 or 10 years in this industry, you might want to go out there and start your own firm, start your own hedge fund, start an investment firm. The baby boomers are retiring. So 5 to 10 years, these 70-year-olds who are buying these 40, 60 portfolios, there's going to be a bunch of them. They're going to have millions of dollars. There's going to be billions of dollars out there. I'm hoping one of you will call me and say, "Hey, Professor Sweet, assuming I'm still, have my mental faculties, I'm not in some retirement community and completely forgotten everything about finance, call me up. I'd be a free consultant to a firm like that." I really think our industry desperately needs some new innovation when it comes to managing risk for people in retirement. Now, William Sharp is someone if you're interested in this, he's someone to look into because he is doing much research in this area. And boy, he's getting up there in age. I don't know how much longer he's going to be active in this, but if you go out and search, his latest work has been really focused on those people going into retirement. What's the best way to handle them now that they're taking money out? What's the best way to handle it? And he also says the same thing I do, that no one's working on this. My life insurance class, we talked about that. No one's talking about this. There's this kind of inertia of everybody investing for retirement. And the whole industry, that's how they make money. The industry doesn't make money helping people take out their money, start withdrawing money for their retirement. And so there's an opportunity there that you could start a business and make a lot of money. So let me show you the strategy one other way so you can kind of see how I think about it. So in this strategy here, I do compare it to just stocks. So this is not the perfect comparison, but so let's say you bought the SPY. The SPY is the S&P 500 Exchange Traded Fund. You buy that. Let's say you I don't know how large the portfolio is, but well, I guess I do. It starts at 130 or 135. I don't know why I picked that number, but there's your starting point. 133.51. No telling how I'll set it up like that. It's actually in here. I was using live numbers with actual option prices, so I'm using live numbers. That's why some of the numbers are kind of strange. So if you buy the SPY and it falls in value, this is what happens to your portfolio. If it rises in value, it's just a diagonal line. What does finance say to do? Well, let's reduce this risk by putting some money in the cash or in the bonds. What is that going to do? That's just going to shift the line. You don't know what your max drawdown is. It just shifts the line. And that's assuming -1 correlation between stocks and bonds, because we're assuming when the stocks are down, the bonds are still making their positive return. So it just shifts the line. So let's look at 4 strategies that you could do. All right, so the blue is the SPY. The orange is 60%, 40%. So the maroon strategy is the strategy I just showed you. You're buying puts, selling calls, and you have the S&P. So you can see on the upside, you have much more return than if you just put money in stocks and cash. If you have downside protection, you don't get, but you lose when markets don't move much. Now this blue this is my strategy when insurance is cheap. So what I mean by that, every once in a while stock markets give options at a really cheap price. So you can watch what's called the volatility index. When it falls below 10, insurance is really cheap. And the nice thing about that is insurance is cheap in the stock market when risk is the greatest. It's a really strange phenomenon. I remember with the Tokyo earthquake, we saw this strategy when option premiums got really cheap. So we decided to overhedge our student stock portfolio because it was so cheap. And then the stock market crashed, and when the stock market fell 10%, we were actually up 11% because we bought more insurance than me. It's almost like you have a fire out in the forest outside of your house and you don't have any insurance, so you call your insurance company and say, "Hey, I want homeowners insurance." And they say, "Well, we have a special right now. You can buy 2 times insurance for the price of 1. So if your house burns down, we'll rebuild your house and pay you for another house." And you say, "Well, that's fine, but I got to tell you something. There's a fire outside my house, and it's coming toward my house. So I gotta be honest with you. I got to tell you that. And they say, oh, that doesn't matter. We still have the same deal. That's kind of what the stock market is. When things are the most risky, and the things to me the most risky, when stock investors are the most complacent, and that's when options are the cheapest and the easiest to buy. So I do this every once in a while. I don't do it all the time, but every once in a while I'll say, you know what? This is so cheap. That's why it's on the upside. You get almost the exact same thing on the upside that you would have gotten, but you have a much better downside because the option premiums are so cheap. And so in this scenario, hey, the stock market crashes, I do well. It's kind of like a straddle, really. If you know what a straddle is. It's not set up quite like a straddle, but it's almost a straddle in that you win on the upside, you win on the downside. The only time you don't win is if the markets don't move much. But even then, you don't lose by much. And that's kind of my emphasis is, yeah, there are scenarios where this strategy is just not good at all versus the 40-60. Or here I'm comparing it to a 60-40 strategy. There's strategies where you're going to do worse. But if you think about it, if you could find a way where the option strategy is always better, then everybody would be doing it and be priced out. So there's no way you're going to find a strategy that's just always going to be the best. But again, we're trying to find something that on average is better and has this downside protection. If you can just somehow get your client to be okay with this period of time where they underperform. So one of you go out, if any of y'all want to sit down with me maybe this summer and see if we can find something like this. It's very difficult to do because it's very hard to test historically. But I've actually come to the approach where we don't need to look at this historically because option prices are so volatile, they move around. What I like to do with these strategies is say, take current, and that's what I've done here, take current option prices, let's price everything, put it together, and then run scenarios. And the scenarios are really easy to run. The stock market falls 50%, it's up 50%. And if you have the options in place, you know what your outcome's going to be because you know exactly how the options are going to perform. So you can set up this strategy and you can actually draw these pictures for the strategies based on what current option prices are. So you know for the next year, these are your possible outcomes. And you can tell your client, here's the scenario where you'll be worse off. Up to here, after this point, you'll be better off with our strategy. After this point, you'll be better off with our strategy. So, yeah, think outside the box, be unconventional. Think radical because I do think there's some opportunities out there.